In this TikTok compilation, I'm going to be going over some of the investing metrics that you would see on such sites as Yahoo Finance, some things like market capitalization, PE ratio, PEG ratio. So stay tuned and enjoy the video. Let's talk about market cap or market capitalization. So as you can see, we're looking at Facebook, and as of now, the market cap for Facebook is $633.488 billion. That's a whole lot of cash. But what exactly does market cap mean? Essentially, with market cap, you take the price per share multiplied by the number of outstanding shares that are trading on the stock market. So you would just need two variables out of the three to solve for the third one. So for instance, with this, the market cap is $633 billion. You have a price per share of $222.14. We can calculate the outstanding shares. So the number of outstanding shares would be around 2.85 billion shares. Market cap is a great way to compare the size of companies. So you may have heard of small cap, mid cap, large cap. That's what they're referring to, is the market cap size. Small cap is 300 million to 2 billion. Mid cap is 2 billion to 10 billion. Large cap is anything over 10 billion. That's why looking at the share price alone doesn't give you any indication of how large a company is. So here's something to look out for when investing in mutual funds or ETFs. So when you look at mutual funds or ETFs, there's this thing called expense ratio. You can think of the expense ratio as a form of management fee. No matter how the mutual fund performs, you still have to pay that percentage. And that can add up over the years. Before buying stocks, there's always financial metrics that I take a look at, and one of those is the PE ratio. The PE ratio is the ratio for valuing a company that measures its current share price relative to its per share earnings, also known as EPS. In order to calculate the PE, all you need to do is take the current price of the stock, divide by the EPS, and that's your PE ratio, or it's also called the earnings multiple. So to show this formula in action, let's look at Facebook. We have a current price of 189.55 and an EPS of 5.91. So if we take the current share price divided by the 5.91, let's see what we get. Based on that, we get a 32.07. compared to the 32.06, so pretty close. If you think about it, the PE ratio is essentially taking the net income and how many years it would take of that same net income in order to cover the entire market cap of the company. You can use PE ratio for similar companies in the same industry to compare overall value. In today's stock analysis video, we're going to be going over the PEG ratio, or also known as the PEG ratio. In part 2, we went over the PE ratio and exactly what that is, but the PEG ratio takes it one step further and also incorporates the growth rate of the company, or specifically the growth rate of the EPS. The PEG ratio gives a better understanding if a company is overvalued or undervalued based on its future growth aspects, and I'll show you just how. So the exact formula is just PE ratio divided by EPS growth. So the PEG ratio is something that I use, and I do specifically follow Peter Lynch's advice. So when the PEG ratio is 1, that means a company is relatively fairly valued. If it's less than 1, it's undervalued. If it's over 1, it's overvalued. I'll show you a quick example to prove this point. Company A has a PE ratio of 22, and Company B has a PE ratio of 30. So if you just compare that, Company A is better, right? Actually, after you factor in the growth rates, Company B is a better value to buy. Let's talk about stock beta. Beta is the measure of a stock's volatility compared to the overall market. A beta below 1 usually means less risk. A telecom company like AT&T is less risk. A company like US Steel has a beta of 3.04. When the market moves, US Steel moves. A company like Ford has a beta close to market. In this video, we're going to talk about gross margin, operating margin, and then net profit margin. In this example, let's say you sell 4 packs of cards at $250 a piece, or $10 total in sales. Let's say that it costs around 50 cents per pack of cards in order to make each pack of cards. So your gross margin would be $8, so you take away $2. To get the percentage, you just take the $8 remaining divided by the total sales of 10, so 80%. Operating margin factors in things like administration costs, selling costs, and marketing. So let's say that's $3. Operating margin would be 5 divided by the 10 for 50%. This is your pre-tax income of $5. The tax man comes along and says, oh, okay, well, we want $2 of this, so you're left with $3 left in net income. So your net profit margin is $3 and 30%. So 3 divided by $10 of sales. So that means every dollar that you make in revenue for your packs of cards means that you get to keep 30 cents in net income. That's why when you're looking at companies to buy in the stock market, you want to look for companies that have high net profit margin. Before buying a stock, you should always look at the debt to equity ratio and understand how leveraged a company is and whether that's normal for the industry or if they're highly leveraged and that could cause issues down the road. So what exactly is the debt to equity ratio? The formula is quite simple. It's just total liabilities of the company, so basically what they own in debt, versus how much the company actually owns in shareholders' equity. So here's a quick example to make that a little easier to understand. Part of that is understanding the balance sheet equation. So assets equals liabilities plus shareholders' equity. So let's say I own an ice cream shop. I have $100,000 in cash, and then I owe people about $50,000. So that would be my liabilities, and my assets would be the $100,000 in cash. So based on that equation, that means we have $50,000 in shareholders' equity. So in this situation, it'd be 50,000 divided by 50,000. So your debt to equity ratio is 1. If we take a look at a company like GE, their debt to equity ratio is 330. That means they're leveraged balls to the wall. It's not always bad to have debt, but it's bad to have too much debt. In a recession, these highly leveraged companies get hurt worse. Have you ever come across the term book value when it comes to investing and asked, what is book value? And it's not the value of the books that the company's holding. If you take a look at JP Morgan, the price of the stock is $137.46 right now. If you scroll down, you can see that the book value per share is only $74.61. The easiest way to think about book value is if you liquidated the entire company, how much in assets would each of the shareholders receive? The book value or carrying value is essentially just assets minus liabilities or the stockholders' equity. To get the book value per share, you would just take that total book value and divide by the amount of common shares. This investing metric is used by value investors to determine if they're overpaying or underpaying for the price of the stock. These value investors look at the price to book value ratio and determine whether or not a stock is priced relatively attractive. Anything under 3 is considered okay, and anything under 1 is really good value. That means JP Morgan's at a 1.84. Hope you learned something new today, and if you did enjoy this kind of content, make sure to like and subscribe. Have a great day.